Good day, everyone. Today's topic is about CVP analysis, or what we call cost volume profit analysis. Sometimes this is known as the break-even analysis. So today we will be having some exercises, theories, and problems about the break-even analysis. So when you say break-even, that is a point when there is no profit or there is no loss. So meaning the total revenue would be equal to your total expenses. So therefore, if you deduct the total expenses from the total revenue, so that would give you zero, no profit, no loss. So let's begin with the CVP graph. Okay, so in your y-axis, we have here the amount, or in terms of pesos. In your x-axis, we have here the number of units sold. So let's begin with the total revenue line. So remember, if there is no unit sold, there will be no revenue. So you will start at this point. And as the number of units increases, the total amount of your revenue will also increase. That's why your total revenue line is sloping upwards. And then we also have here the total cost line. So if you are able to sell 0 unit, so you still incur certain amount here of your cost because of your fixed cost. And as the number of units increases, it will now start to slope upward. And that is because of your variable cost. So you add your total fixed cost and your variable cost to arrive at your total cost. And when these two lines, the total revenue and the total cost lines, will intersect. Ayan. When they intersect, this is now what we call the break-even point, meaning the total revenue is equal to your total cost. So break-even point in terms of sales, or in peso, and then break-even point in terms of the number of units. So if ever that you will be selling more than the number of units sold, to break even. So maybe at this point, if you look now at your graph, the total revenue is on top of your total cost line. And then the difference is actually your profit. But if you're able to sell less than the number of units to break even, so if you look at the lines here, the total cost now is above the total revenue line. So that will now give you loss. Okay, so let's have some theories. So the first one is contribution margin can be defined as, so let's read. A, the amount of sales revenue necessary to cover variable expenses. Or B, sales revenue minus expenses. Or C, the amount of sales revenue necessary to cover fixed and variable expenses. Or D, sales revenue minus the variable expenses. If you are using the CVP analysis, you can actually convert the usual income statement into a contribution margin approach. So that would give us this kind of format. So sales minus all your variable costs or expenses. That would give you your CM, or contribution margin. And if you continue, if you deduct your fixed cost, that would give you the operating income. Okay? So to answer the question, contribution margin is actually letter D, the sales revenue minus the variable expenses. Let's now proceed with the next one. So which of the following is true regarding the contribution margin ratio of a single product company? So is it A, as fixed expenses decrease, the contribution margin ratio increases? Or is it B, the contribution margin ratio multiplied by the selling price per unit equals the contribution margin per unit? Or is it C, the contribution margin ratio will decline as unit sales decline? Or D, the contribution margin ratio equals the selling price per unit less the variable expense ratio? So if you look at the formula, contribution margin ratio is actually the CM over your sales. Okay? Contribution margin over your sales. Or it could be expressed in terms of per unit. So it could be CMR equals your CMU, or contribution margin per unit, over the selling price per unit. Okay, so if you transfer to the left side of the equation, it will now become CMR times your SPU. That will be equal to CMU. And this formula actually fits for letter B. The CMR multiplied by the selling price per unit that would give you the contribution margin per unit. So the answer is letter B. So next, at the break-even point, so the sales would be equal to contribution margin, or is it B? The contribution margin would be equal to the fixed expenses, or is it C? The contribution margin would be equal to net operating income, or D? Sales would be equal to fixed expenses. Now let's show again the contribution margin approach in preparing the income statement. So sales minus all your variable costs would be equal to your contribution margin minus all your fixed costs, that would be equal to your operating income. Remember, at break-even point, the operating income is equal to zero. And that will only happen if your contribution margin would be equal to your fixed expenses. So the answer is letter B. All right. But just to add more information, again, the formula that we'll be using in almost all our problems would simply be the X equals FC over CMU, wherein X is the number of units to break even. The number of units that must be sold to break even should be equal to your fixed cost divided by your contribution margin per unit if you are asked for the number of units. But if you are asked for the amount of sales to break even, the formula would still be almost the same. It's just fixed cost over this time is contribution margin ratio. It's easy to remember. If it's break even, in terms of units, the denominator should be CMU. And if it is in sales, the denominator should be the ratio. All right. So, of course, the company would target some certain amount of income. So, if the problem would give you target operating income, you just simply add that in your numerator. Okay? So, add that in your numerator, and that would give you the number of units that must be sold to achieve the certain operating income. And that is the before tax income. Okay. So that would also be the same for the sales to achieve the break even, to achieve the sales that would give you the desired income. So you can easily compute using this formula. But at break even point, remember OI is zero. So therefore, the formula would simply be FC over CMU or FC over CMR to get the break even point. All right. Sometimes the target income is not uh, before tax. Just in case that the target income is given as after tax, all you need to do is to divide that income or net income or after tax income. You divide it by 1 minus the tax rate. So therefore, if the tax rate is 40%, you divide it by 60% because the numerator here should be before tax. Okay, so I think that's enough for the break-even point. Let's move to the next one. Margin of safety. So before we already mentioned that the margin of safety is the difference between your sales, whether actual or budgeted or forecasted or estimated sales, less your break-even sales. That is your margin of safety. And remember, the break-even sales or sales would be equal to your FC over CMR. And if you look at the choices now, which one would fit the formula? So is it A, sales minus fixed expenses over contribution margin ratio? And I think letter A is correct. Okay. So, what does margin of safety mean? So, for example, if you have 150,000 of your sales and then your break-even sales would be around 120,000, meaning that is to break even, no profit, no loss. So the margin of safety is 30,000, meaning if your sales will go down with as much as only 15,000, you are still safe because you will not be having any loss. You will still have income. So that's why it is called safety, margin of safety, because your sales can go down with this much without experiencing any loss. So if your sales went down by 25,000, still you are within the margin. So therefore, you will still have a profit. But if your sales will go down by 42,000, for example, this time, this is more than the margin of safety, meaning even if you don't compute, you will be having a loss. All right? So that's margin of safety. So the answer is letter A. So let's move to the next. So if both the fixed and variable expenses associated with the product decrease, okay, so what will be the effect on the contribution margin ratio and the break-even point? So let's show again the formula. CMR is your CMU over your um, SPU. All right. So remember, CMU again is SPU minus VCU. That is a selling price per unit minus a variable cost per unit over SPU. The second item that we're going to look uh, into would be the break-even point. So it's either X equals FC over CMU, meaning the number of units to break even, fixed cost over contribution margin per unit, or in terms of sales, that would be FC over CMR. So what will be the effect on the CMR and the break-even if both the fixed and variable costs associated with the product decrease? If you look at the CMR, only the variable component could affect the CMR. So it was said here that the variable cost will decrease. So what would be the effect on the numerator? The numerator will actually increase because you will deduct a lower value. So therefore, that would give you a higher contribution margin. So the first answer is increase. So what will happen with the break-even point? So let's just look with the fixed cost. If fixed cost will decrease, what will happen to the numerator? It will decrease. Therefore, the number of units will decrease. Okay, so the answer is letter B, increase for the CMR and then decrease for the break-even point. All right, so let's move to the next. So which of the following strategies on the selling price per unit and fixed cost could be used to reduce the break-even point? So again, you just visit the formula to break even, to achieve the break-even point rather. So X is FC over CMU, so or sales equals FC over CMR. So what would be the strategy for this SPU so that the break-even point would be reduced? So SPU is where? So if you look or if you expand the formula, that's FC over SPU minus VCU. So to reduce the break-even point, so you must increase the denominator. And for the denominator to increase, you have to increase your selling price per unit. So the answer for the first one is increase the SPU. So what will you do with the fixed cost to reduce the break-even point? So obviously, if you want the answer to be reduced, you have to reduce also the fixed cost. So the answer now is increase the SPU and decrease the fixed cost. So the answer here is letter D, increase, decrease. All right. So next, so which of the following is the correct calculation for the degree of operating leverage? I would like to show first the income statement under the contribution margin approach. So that would be sales minus the VC, we have the CM, minus the FC, we have the operating income. Okay, so which one is correct to calculate the degree of operating leverage? Is it A, net operating income over the total expenses, or B, the net operating income divided by the contribution margin, or is it C, the contribution margin divided by the net operating income, or D, the variable expense divided by the total contribution margin? The answer is actually would involve the CM and the OI, but it is the formula that DOL is CM over OI. So the answer is letter C. Aside from this formula, you can actually compute for a DOL using the percent uh, change in your operating income over the percent change in your sales. Okay, if your CM and your OI If both or any of these two is not available, you can make use of this formula as well. All right. So the answer is letter C. Let's have this one. If the DOL is equal to 4, then 1% change in quantity sold, just like what I've mentioned a while ago, should result in a 4% change in what? So again, percent change in your operating income or profit over the percent change in your sales. So if there is 4 here, therefore, there is 4% change in your operating income. Okay? So the answer is dog. Okay, so let's move uh, to a problem. So we will be answering all these requirements. There are six sets of requirements, and we will be answering one by one. So let's begin. Okay, for the first one, we are asked compute for the unit contribution margin and the units that must be sold to break even. And suppose that 30,000 units are sold above the break even. What is the profit? Let's read the problem. So Zaccarello Company produces single product. So we have here the projected income statement. Okay, so the first question is about the CMU. So how do we compute for the CMU? Again, that is your CM over the number of units. Okay, you can express the total CM here in terms of units. So that is simply 1,060,000 divided by how many units are there? 50,000. Okay, so therefore your CMU is equal to 21.20. Okay, so for the next question, how many units must be sold to break even? So again, the formula would be X equals FC over CMU. Okay, so what is your fixed cost here? It is given as 816,412 divided by the calculated CMU here of 21.20. So for you to break even, you must be able to sell 38,510 units. Okay, so suppose that 30,000 units are sold about above the break even. So what is the profit? So there is contribution margin of how much. We can actually go straight to the contribution margin since we already know that the CMU is 21.20. So if we are able to sell 30,000 above the break even, meaning uh, break even is remember is there is no profit or there is no loss. So whatever change in the CM or contribution margin is also the change in your profit. So your uh, your CM here, the change in your CM would be equal to the 30,000 units above the break even multiplied with the 21.2 CMU. So that would give you 636,000 pesos. Okay. This change in your CM is also the change in your profit. But remember, we are comparing with the break even. So there is increase of 636,000 when compared to zero. Therefore, this is the profit when we sell 30,000 units above the break even. So 636,000. Okay, so let's move to the second one. We are asked to compute for the contribution margin ratio and the break-even point in pesos. So let's begin with the CMR. The CMR is, remember, it could be your CM over sales, and that would be your 1,060,000 divided by your sales of 2,500,000. So that would give you contribution margin ratio of 42.4%. Okay, so how much must be sold? Or how much should we generate to achieve the break-even point? So sales would be fixed cost over the CMR computed. So the fixed cost is still 816,412, and you just have to divide it by 42.4%. And you will arrive with the amount of sales of 1,925,500. For you to break even, you should sell 1,925,500. And obviously, the company projects 2.5 million. So therefore, we are expecting operating income. But it says here, just a continuation, that suppose that revenues are 200,000 more than expected. So what would the total profit be? You can actually have two approaches here. So you can get first the change in your contribution margin. Remember, that would be 200,000 additional sales. So just get the additional contribution margin by multiplying it with the contribution margin ratio. So the answer here is how much? That's 84,800. That is the additional CM because you sell 20,000 more than expected. So if you're asked for the total profit, so you just have to add the existing operating income or your expected operating income. So you add 243,588. So what do we have here? That is 328,388. So that would be your profit if you are able to sell 200,000 revenues more than the expected. All right. So let's have number three and number four in our screen. So we are asked to calculate the margin of safety. Remember, MOS is equal to your sales or your projected sales of 2.5 million minus your break-even sales. We already computed the break-even sales in number two. So the sales here is 2.5 million less the break-even sales of 1,925,500 computed in the previous slide. So therefore, the margin of safety is how much? 574,500. Meaning, even if your sales go down with as much as 574,500, you will not experience a loss. Okay, you will still have a profit. So that's the margin of safety. We are actually asked for number four for the operating leverage. So for number four, DOL is again your CM over your OI. So that's 1,060,000 divided by your OI of 243,588. So therefore, your DOL is, how much is this? 4.35161, or we can simplify it as 4.352. Okay. Okay, this time we are asked to compute for the new profit level if sales are 20% higher than expected. Okay, so we can have this 20% higher than expected. How much is that? So again, we get the difference in your CM. And then the difference in your CM is, remember, 1,060,000. There is 20% higher than expected. Multiply it by 20%. How much is this? You will arrive with 212,000. Okay. So if you add the expected profit, so that would be 243,588. So the new profit level would be how much? 455,588. Okay. There is another way of computing for this one. Remember that your DOL is equal to your percent change in your profit or operating income over the percent change in your sales. So it was said here that there is 20% sales, a change in your sales. So the DOL here is 4.35161, and that is equal to what is a percent change in OI, percent change in operating income over the percent change in sales, which is 20%. Now, if we compute what is the percent change in operating income? So that is simply 4.35161 times 20%. So that would give you how much? That is 87.0322%. Okay, so let's use more decimal places to avoid differences due to rounding off. If this is a percent change in your operating income, so currently we have the projected 243,588 of your operating income. If you multiply it with 1 plus the 87% change, so meaning 187.0322%, if you multiply it with this one, you will still arrive with the answer of 455,588. Okay? So either way can be used, but if you can see, the second computation is a bit longer than the first one. Okay, so you can use either of the two, whichever you are more comfortable with. So let's continue with number five and number six. So we are now asked for the number of units that must be sold to earn a profit equal to 10% of sales. So we simply make use of the formula X, number of units. Okay, so that would be FC plus the operating income over your CMU. Let's substitute. So X would be equal to the fixed cost is 816,412 plus 10% of sales. So 0.10 of your sales, the profit. And your sales is actually equal to the SPU X, meaning the selling price per unit times the number of units. But we know already what SPU is. So the selling price is 50. So meaning the sales at any particular level is 50x. Okay. And we assume that the profit is equal to 10% of your sales all over your CMU of 21.20 computed a while ago. That's 1,060,000 divided by 50,000 units. Okay. So you can see here it's 21.2x equals 816412 plus simplify the two uh, variables here. 0.10 times 50x, that would be 5x. So when you now combine the items with x, so that would be 16.20x equals 816412. So x this time is equal to how many units? That's 50,395.8. But we have to round up. That's 50,396 units. You should be selling 50,396 units if you want to achieve a profit that is 10% of your sales. Okay, so with number six, we have to assume this time that the tax rate is 40%. So how many units must be sold to earn an after-tax profit of 180,000? So for number six, X should be 816,412 plus the after-tax profit of 180,000. Remember, the profit that we put in the denominator, in the numerator rather, should be before tax. So therefore, you have to gross this up. So you divide it with 1 minus the tax rate or 60%. Okay? So because the tax rate is 40%, so divide it by 60%. And then you divide everything by the CMU, which is 21.20. So what do we have here? 21.2x is equal to 816,412 plus 300,000. So you can compute x here as 52,660.94 or 52,661. Okay, so we're done with this problem. Let's move to another set of problems. So this time we will be showing the effects on the operating income of changes in variable costs, fixed costs, selling price, and sales volume. So let's have this example. So RBC Company had the following performance in March 2024. So we have here sales of 250,000. So meaning the selling price per unit is actually 250,000 divided by 500 units. That's 500. That is your SPU. So we have variable expenses of 150,000, meaning the VCU is 150,000 divided by 500 or how much is that? That's 300. And then for contribution margin, we have 100,000 or 200 of CMU. And then The fixed expenses is 80,000, so that's why we have here net operating income of 20,000. So let's have the first problem. So what would be the profit impact if RBC can increase its unit sales from 500 to 540 by increasing the monthly advertising budget by $10,000? So remember, so we have here advertising budget that would increase. And remember, this is also another fixed cost. So let's just show what would be the profit impact. Okay. So let us prepare the new income statement if there will be 540 units sold. So your sales would be 270,000. So that would be 540 units times 500 pesos. And then your variable expenses would be 300 times 540. That's 162,000. And then your contribution margin is 270 minus 162. That's 108,000. But for your fixed expenses, remember, there is increase of 10,000 in your advertising expense. So therefore, that should be 90,000 now. So the net operating income is now $18,000. So if we compare now, what happened? Your net operating income, despite the increase in your sales of $20,000, there is decrease in the net operating income of or by $2,000. So therefore, if you assess the situation, it's not good to advertise because you will decrease your profit by $2,000. All right. So in problems like this, you just have to prepare another income statement, and that is actually quick to do. So let's have the shortcut for this one. Since there is increase in the CM or contribution margin by simply getting the 40 units increase by $200. So we computed the increase in the CM as $8,000. And remember, in your fixed cost, there is also increase because of the advertising expenses of $10,000. So all in all, because there is more increase in the cost compared with that of the revenue, therefore we will be having a decrease in net operating income of $2,000. We can use this shortcut, or you can just use the usual way of preparing another income statement to look at the new income and compare it with the other or with the current scenario. Okay, so let's continue. Same problem, but this time we are asked on the profit impact if RBC can use higher quality raw materials. So, meaning if there is higher quality raw materials, we can expect that there is increase in the variable cost per unit by $10. So that is to generate an increase in unit sales from 500. This time it's 580. So all we need to do is to take effect the changes. So let's prepare another income statement out of the current scenario. So for 580 units, the sales would be 290,000. So that's 580 times $500. And then for the variable expenses, remember, there is increase in the variable cost because of the higher quality raw materials. So from 300, it will now become 310. So multiply it with 580 units. So that would give you $179,800 of variable expenses. For your contribution margin, get the difference of the two. So you have 110,200. And then less the fixed expenses. Is there any change in the fixed expenses? There is none. So therefore, it is still 80,000. So the operating income is now 30,200. So if you look at the situation, it's good that you purchase uh, materials with higher quality because that would give you increase in sales of 40,000, and ultimately that would give you increase in your operating income of $10,200. Okay, so let's have another example. So what if this time there are a lot of changes? So first, you will cut the selling price um, 20,000, $20 rather per unit. And then you increase the advertising budget of $15 per month. And with those efforts, you will be increasing your sales from 500 now to 650 units per month. So what would be the profit impact? So let's compare again from the previous situation of 500 units. Your sales now is would be reduced. Remember, the selling price would be cut by 20 per unit. So this time, instead of 500, it's now 480. 480 times 650 units would give you a sales of $312,000. For the variable expenses, there is no change in the VCU. So you just simply multiply 300 by 650 units. So that would give you 195,000. And then your CM is the difference between the two. So we have 117,000 contribution margin. Your fixed expenses, remember, there is increase in your advertising budget of $15,000. Therefore, your new fixed expenses would be 95,000. Therefore, your operating income because of these efforts will now become $22,000. Still good efforts. Why? Because first, the sales would increase by 62,000. Yes, the fixed cost will increase by 15,000, but ultimately, the operating income would increase by $2,000. All right. So let's have another example. So there are some changes again here. So for number one, we pay a $15 sales commission per bike sold instead of paying salespersons flat salaries that currently total 6,000 per month. If you look at this, we are replacing the fixed cost with the variable cost one. Okay, so what would normally be the effect if you do that? Remember, if you impose a flat commission to the employees, so once they are able to reach their quota, so they will already receive the incentive. But imagine the efforts that they would exert if they already reach the quota, probably they would not sell any more bike. But if you change the fixed commission to variable one, the more bikes that the company sell, the more commission that the employees would get. So meaning they will be more motivated if you do this. But let's check first if the number of units or the increase in the number of units would be enough to say that this strategy is a good one. So again, you will be paying a variable cost per unit or per bike sold instead of the fixed cost per month. And with that, the unit sales would increase from 500 to 575 bikes. So let's prepare another income statement from the current situation. So for your sales, so what would happen to your sales? It's 575 times $500 per unit. So that would be 287,500. For your variable expenses, what will happen? Before we have 300, but now we are increasing that to 315 because of the strategy. So 315 variable cost per unit multiply let's multiply with this with the number of units 575, so we have 181,125. Okay, so now we have the contribution margin of 106,375. So how about the fixed expenses? What will happen? Remember, we will replace the fixed expenses with the variable ones. So therefore, the fixed expenses would be reduced. So what would be your new fixed cost? That would be 74,000. And with that, the new operating income would be 32,375. So with these efforts, we can now see that the net operating income increased by 12,375 given all those changes. Okay, so generally we could say that that the strategy is effective. All right. So let's move to the next one. This time, there are changes in the selling price. Okay, and some problems would ask you what would be the selling price that you would be setting for you to achieve a certain income. Okay, so let's have this same problem but different scenario. So if RBC has an opportunity to sell 150 bikes to a wholesaler without disturbing sales to other customers or fixed expenses. So, what price would it quote to the wholesaler if it wants to increase monthly profits by $3,000? You can compute now. But in problems like this, we just have to show the increase in the profit. So now the net operating income would be 23,000. That is a target. Okay. So your fixed expenses uh, were not actually disturbed. So therefore, it is still 80,000. So we just work back. So what would be your new contribution margin? That is 103,000. Remember, the 103,000 contribution margin is for 650 units. And remember that you will not be disturbing any sales to the other customers. So therefore, you have to take out the contribution margin pertaining only to 150 units. So with that, the CM for 150 units would be 3,000. And we are asked for the selling price per unit that must be charged uh, to the wholesaler trying to buy 150 bikes. So all we need to do is to divide it by 150. So therefore, we will be having contribution margin per unit of 20. And if we work back, we just have to add back the variable cost per unit. Remember, the VCU is 300. Therefore, the selling price is 320. So that's the answer in this problem. Okay, you just have to work back. So let's have the second scenario. So what if this time, if RBC has an opportunity to sell 150 bikes to wholesaler without disturbing sales to other customers? However, the delivery cost would increase by 15,000 because of that additional bikes that can sell. So what price would it quote the wholesaler if it wants to increase the monthly profits by 3,000? So how do we do this? So let's reflect again the change in the operating income. So the new operating income for 650 units would be 3,000 plus 3,000 rather. So that would be $23,000. What will happen to your fixed expenses? It was said here that this will increase by 15,000. So your new fixed expenses would be 95,000. Therefore, the contribution margin is 108. That's 118 rather. It's 118,000 if you work back. Okay. So now, remember that 180,000 is for 650 units. Therefore, if you will not disturb the 500 units sold to other customers, you have to take out the contribution margin pertaining only to the 150 units. So if we remove the 100,000, so the CM for the 150 units would be $18,000. And we are asked for the selling price. So how much do we charge that particular wholesaler? So we divide it by 150. And then your answer is $120 dollars per unit. So how much would be the selling price? We have to work back again and add the variable cost per unit of 300. So what would be your selling price? 120 plus 300. So it should be 420. So that's the answer in this problem, 420. Mhm. So next problem. So what if this time there is still opportunity to sell 650 bikes to a wholesaler, but this would take also the sales to other customers. So also the delivery cost would increase by 30,000. So how much or what price would it quote the wholesaler if it wants to increase monthly profits by $10,000? So again, we just work back. Okay. So the profit should increase by $10,000. So therefore, the new profit that we expect is $30,000. And what would happen to our fixed expenses? It says here that the delivery cost would increase by 30,000. So the new fixed expenses would be 110,000. Your new contribution margin would be 140,000. But this is for 650 bikes. But this time you will take also that the sales. to other customers. So therefore, that 140,000, the amount would be representing the contribution margin for all the 650 bikes that would be sold to a wholesaler. Therefore, from here, we can compute the CMU per unit, CMU divided by 650. So the answer is 215.38. And this is the CMU that we are expecting from this transaction. So now we will add back the variable cost per unit. So therefore, the selling price that must be charged to this wholesaler that would get all the 650 bikes would be 515.38. So that's the answer. Okay. So let's move to the next one. What if this time there is an opportunity to sell 800 bikes to a wholesaler and we will disturb all the items here? Okay. So it would take also the sales from that to the other customers, plus the delivery cost would increase by 40,000. So the fixed cost is still affected, while the cost of parts will decrease by 10%. So now even the variable expenses would be disturbed. So what price would it quote to the wholesaler if it wants to increase the monthly profits by $10,000? Okay, so this time, let us reflect the the changes that were mentioned in the problem. So the new profit will now become 30,000. But what would be your fixed expenses now? So it says here that the delivery cost would increase by 40,000. So this now is 120,000. So the CM would be 150,000. But again, since it will disturb all the sales to the other customers, this represent the 800 bikes to be sold to the wholesaler. So you divide it by 800, you will get the CMU. So 150,000 divided by 800, so that's 187.50. So how much is your variable cost now to be added back for you to achieve the selling price or to get the selling price per unit? Remember, even your variable cost is now affected. There is a decrease by 10%. So your variable cost per unit is 300. So less than 10% or multiply it by 90 percent. So your new variable cost per unit is, that would be 270. So what would be your selling price now? You just have to add back the new variable cost per unit. So therefore, the selling price would be 457.50. So that's your answer. So that would be the selling price for every bike that you will sell to that wholesaler who will get 800 units from the RBC. All right. So we are down to our few more problems. So let's have Janus Corporation. So it says here, Janus Corporation produces and sells a single product. So here are the data pertaining to Janus Corporation. So let's check first the question. So what should be the overall effect on the company's monthly net operating income because of these changes? Okay, so meaning we are talking about the overall effect. So since this time the current net income is not given, so we will compute for that, and then later on we'll compute for the new income because of these changes and compare the two operating income. So let's begin. So the company is currently selling 600 units per month. So we can actually begin here by getting the CM by multiplying the CMU of 52 by 6,000 units. So how much do we get here? It's 312,000. So that's our CM. Okay. You can actually solve directly from CM. You don't need to start from your sales because it's already given here. So 52 times 6,000 units. And then you deduct the fixed cost. And fixed expenses are 263,000 per month. So you just have to deduct 263,000 here, and you will get the operating income at present of $49,000. Now, so what would be your new income? So it says here that the marketing manager believes that a 5,000 increase in the monthly advertising budget would result in a 140 unit increase in monthly sales. So what would the effect? Would be the effect on the profit. So the new CM would be, how much is the CMU? It's 52. And let's multiply it with 6,140 units because there will be an increase of 140 units. So the new CM would be 319,280. And then the fixed cost would be, before it's only 263,000, but there will be an increase of 5,000. Therefore, the new fixed cost is 268,000. Therefore, the new operating income is 51,280. So if we compare the two operating income, so there is an increase of how much? 2,280. So the answer here is letter A. Okay. Okay, so we're down with the last problem. So we have here a Gosnell company that produces two products, squares and circles. So here is the projected income for the segmented for the product lines. Okay, so we have here squares and circles. So what would be the question? So we are asked for the number of units of each product that must be sold to break even. Okay, so this time there are there are two products involved. So the formula would still be the same. X is equal to FC over CMU. But this time, we will make use of the weighted CMU because there are two products involved. Okay, so we just have to prepare a schedule or matrix. So what are the products here? So we have the square and the circle. We just make use of S and C. So we get the sales mix. We get the CMU or contribution margin per unit of each product, and then we multiply the sales mix by the CMU to get the weighted CMU, and finally, we get the X or the number of units that must be sold. So, what is the sales mix? So, for squares, we have 300,000 sales. And how much is the selling price per unit? It's 30 for squares. 300,000 divided by 30, meaning we are selling 10,000 units of squares. And for circles, how many units are being sold? Oh, will be sold here in the projected income statement. So we have here 2.5 million of sales divided by the 50 pesos of selling price per unit. So how many units do we plan to sell? 50,000. Okay. So meaning, if you look at this, we can make use of the sales mix that for every square or 1 unit of square, we are selling 5 units of your circles. So sales mix is 1 and 5 for S and C respectively. How much is the CMU for each product? For squares, 200,000 is the CM. You just have to divide it by 10,000 units. So how much is that? 20 per CMU. But for circles, we have 2 million of contribution margin divided by 50,000 units. So that would be 40. So the weighted CMU, this is weighted CMU. Ayan. So we just multiply the sales mix by the CMU. So we have 20 for squares. And then for circles, we have 5 times 40, we have 200. So the total weighted CMU is 220. So from here, let's compute for the number of units that must be sold to break even. So step 2, so FC is how much? We have the direct fixed expenses of 1,528,000. And we also have common fixed expenses of 100,000. The question is, are we going to include this one? The answer is yes. Because otherwise, we will not be getting the correct answer to break even. Okay, so the fixed cost would be 1,628,000 divided by the weighted CMU of 220. So we will be able to get the composite break even of 7,400. And then the last step would be multiply the composite break even with that of the sales mix. So 7,4 times 1 4 squares. So we should be able to sell 7,400 squares. And 7,4 times 5. So how many is that? So we need to sell 37,000 units of circles to break even. All in all, we need to sell 44,400 units of all the products. But the question is for each product. So again, 7,400 for squares and then 37,000 for circles. All right. So let's have the final question here. So assume that the marketing manager changes the sales mix of the two products so that the ratio is 3 squares to 5 circles. So all we need to do is just to prepare again another table or schedule. So here are your products. We have the squares and your circles. So we need to get again the sales mix. And this time it's 3 squares for 5 circles. Okay. And then we need the CMU. Remember the CMU for squares, we have here 20. And then the CMU for circles is 40. So therefore, we will get the weighted CMU. So that would be 3 times 20, so 60. Then 5 times 40, that would be 200. So the total weighted CMU is 260. And we are asked for the number of units of each product that must be sold to achieve the operating profit of 140,000. So what would be that X or number of units? So again, X is equal to the fixed cost over weighted CMU, but this time we will add the operating income or profit, the target one. So we have here the 1,628,000 of fixed costs, the sum of 1,528 and 100,000 here, plus your target profit of 140,000 divided by the weighted CMU of 260. So the composite amount is 6,800. So what do we do next? Again, we multiply with the sales mix. So 68 times 3. So how many do we have here? It's 20,400. And then for circles, we have 68 multiplied by 5. So we have 34,000. Therefore, for you to achieve a profit of 140,000, you have to sell 54,400 units of your products. And specifically, 20,400 for squares and 34,000 for circles. So that ends our review under the CVP analysis. And again, thank you very much.